Hi there, welcome to Kneppy Invest. In today's video, I am going to discuss the disastrous IPO that is step one. Step one, they sell men's underwear, even women's underwear now, online, a purely online player. They are expanding quite quickly and growing, or have been growing quite quickly. They listed on the ASX late 2021, I think it was November 2021, over $2 the share price was. In fact, share price almost got to $3, if I remember correctly. But the current share price is 30 cents right now. And a few days ago, from when I'm doing this video, the company released a trading update. And on the back of the trading update, the share price fell 50%. Now, when we're talking about the sale of men's underwear, there is a fascinating link between men's underwear and the state of the economy. And to link those two things, we actually have an index, and that index is Men's Underwear Index. Now, there are plenty of really interesting indexes out there that try to link stuff to the state of the economy. For instance, there's a lipstick effect, hemline effect, also the skyscraper effect is probably one of my favorite indicators. But the Men's Underwear Index was formulated by Alan Greenspan, I think in the 1970s, but it became really popularized in an NPR interview in January 2008. I forget who the interviewer was, but Alan Greenspan mentioned how men's underwear, or the sale of men's underwear, takes dips when the economy is under stress. And the thinking behind this index is as follows. So I got this particular slide from Business Insider. It's an article from 2014, but it is still relevant. And the Men's Underwear Index operates under the theory that sales of men's underwear are typically stable because they are considered to be a need, but not a luxury. However, during times of financial downturn, men will try to stretch the time between buying new pairs, causing underwear sales to drop. And a good way to think about this is just imagine a family of six. And during bad times, and more than likely, if you do have a family of six, it's going to be the mother who is going to be buying the father's underwear, more than likely. Maybe not absolutely, but I think that is something that does happen quite frequently. And the mother has a choice, either new underwear for the father or food for the kids. And of course, the kids are always going to win. So what they do is to delay the buying of new underwear for a couple of months or maybe even a year. This also applies to single males. And to be honest with you, there's going to be a lot of single males who just don't care about the state of their underwear unless maybe they're going on a date and think they might get lucky, and that's when they might actually wear a brand new pair of underpants. But a lot of times they just don't care. So I really do think this really applies to family setups when underwear or the purchase of new underwear can be delayed for a period of time because they want to purchase more necessities, particularly food and fuel and stuff like that. But how reliable is the Men's Underwear Index? And this is again from the Business Insider article from 2014. And to be honest with you, this is only a sample size of one. And they've charted the growth of men's sales or men's underwear. And typically the growth of men's underwear is fairly stationary. It grows about 2 to 3% per year or something like that. But in 2008, the growth in men's underwear began to slow down, and it continued to slow down over the next few years, and then returned to growth in about 2011 and 2012. So this is a sample size of one. And really, a sample size of one tells you nothing. But maybe Alan Greenspan was onto something here. Now let's have a look at step one. And to be fair with you, I knew nothing about this company until they listed on the ASX. Actually, it was after they listed on the ASX when I started to see the share price drop. I was wondering, why is this company share price dropping a lot? I went to the website and I actually am interested in the products this company does sell, and they are getting a lot of really good reviews also. And one of the reasons I'm interested in what this company is selling is simply because I am a runner. And I actually wear compression suits under my running shorts. And they cost something like $100, but they are brilliant for running. And there is potential that step one underwear will be a good substitute for these compression pants at a much cheaper price. So that's why I'm interested in step one. Now, typically, when I buy underwear personally, I go to Walmart, no, not Walmart, what's the other one? Big W or Kmart, and I buy the really cheap bundled underpants, like 5 for $20 or 5 for $30. And to be fair with you, the quality of those underpants are quite low and they don't last too long. Now, my mother has given me as presents some bamboo underwear, and they are absolutely brilliant, really comfortable, and they do last. And step one produces their underwear with bamboo. So that's another reason why I am actually interested in step one underwear. But they are expensive, and more expensive than I'm used to when buying underwear. For instance, most of the underwear sells for $31. Their sports underwear sells for $32, and their thermals sell for $49. So I'm just showing you the men's underwear right here. But step one is expanding, and they are growing. They are now selling women's underwear. They're also expanding into UK and USA. However, even though they are expanding, the company has hit some roadblocks. And you can see those roadblocks just by looking at the chart of step one from when they listed on the ASX in November or late October last year. The share price when they listed was around about $2.75. And in fact, share price reached a high of $3.13 on the 9th of November. But troubled times started around the 22nd of December when the company did release a trading update. Now, I read this trading update, and I could have argued with you that it was actually an upgrade, and I'll talk about this trading update later in the video. But the market disagreed with me, and the share price fell 35%, and that was a sign of troubling times ahead, because the share price continued to fall after that. At that point in time, the share price was around $1.50. And as you can see, the share price just tumbled lower and lower at a gradual rate. So it fell from $1.50 all the way down to 50 cents. So that's a loss of 66% from the 22nd of December to the 15th of May or the 13th of May. And then the company released a trading update on the 16th of May. And that's where we did see the share price drop 56%. And this was a true downgrade. I'll show you this downgrade later in the video as well. And the share price fell as low as 20.5 cents. There was a bit of a rebound, and last time I looked, the share price was at 30 cents. So those who bought at 20.5 cents have seen an actual 50% return in step one over the last few trading days, just because of a little bit of a bounce in the share price. And to be fair with you, with the market well under $100 million at 20 cents, that would have been enticing, even though there's a lot of negative sentiment in this company, even though the company is facing some significant headwinds right now. They are selling underwear when the economy is under pressure. And if the men's underwear index is right, we should see decreasing growth in men's underwear. Now, before we have a look at the profit downgrade the company did release on May the 16th, so we're going to go back in time and look at step one's prospectus. I really like reading prospectuses because they are a trove of information, a smorgasbord of information. You see the risks of the company. They provide the market overview, the company overview, 200 pages of information. I don't go through the whole prospectus. I pick and choose what I want to read about to learn more about that company. So if you do want to learn about a company, particularly those companies that have recently IPO'd, go to the prospectus and you will learn about the company without a doubt. The other thing the company provides in a prospectus is the financial history over the last few years. They also provide guidance for the next financial year. And this is section 1.2, key financial metrics from the prospectus. And the first thing you'll notice when you look at the revenue, EBITDA, and profit over the last few years, this company has experienced significant growth. Revenue has grown from 7.7 million to 61.7 million. EBITDA has gone from negative 851,000 to positive 10.9 million. And profit has gone from negative 541,000 to positive 7.7 million. And no doubt this company is also operational cash flow positive, and more than likely free cash flow positive as well. So why did they list on the ASX? I actually did wonder that. And one of the reasons, not the complete reason, but one of the reasons is they want to expand overseas. And they are expanding overseas into UK and also into the United States. The other thing about this particular site is they gave a forecast for financial year 22, and they expected the growth to continue, maybe not at the rate they have seen over the last few years, but they expected revenue to be about 74 million. Now, this is pro forma revenue and also pro forma EBITDA, 15 million, and pro forma profit, 10.5 million. So this company was expected, or the management of this company expected the company to grow their EBITDA, grow their revenue, and grow their profit in financial year 22. Now let's just have a look at the December 2021 update. And in this particular update, the share price did drop about 35%. And more than likely, the reason it dropped 35% was because of the GST credit overclaim. Because when you look at the trading update, they actually mention they expect sales to grow between 21 and 25% for financial year 22, compared to 19.9% as per this prospectus. So they actually expected this company to grow at a quicker rate than the information they provided in the prospectus. And even because of this overclaim, they still expected EBITDA to be $15 million for the financial year 22. So definitely not a downgrade. So you could say it was an upgrade because of revenue, but the market reacted completely different, and the share price suffered and continued to suffer until the company actually did release a profit downgrade on May the 16th. So let's have a look at that profit downgrade now. The title of this announcement from Step 1 was titled Financial Year 22 Trading Update. Maybe a better title could have been Massive Profit Downgrade from the company, because the share price did fall over 50%. And there was a pretty big downgrade in regards to pro forma EBITDA. They also revised the sales revenue growth. Previous guidance, they expected it to be between 21 and 25%. Now they expected it to be between 15 and 20%. And if you remember the prospectus, they expected revenue to grow 19.9% or something like that. So if they didn't revise their guidance, revenue looks like it would have fallen in line with what they provided us in the prospectus. But when it comes to the expected pro forma EBITDA, that is a significant downgrade. In the previous guidance, they expected it to be 15 million. Now they expect EBITDA to be between 7 and 8.5 million. And this is the whole reason the market absolutely punished this company, because this is a fairly large downgrade. Now, more importantly, is what excuses are they making in regards to these downgrades? So let's talk about revenue first. In the next slide, I'll talk about the profit or EBITDA. So the revision in revenue reflects recent difficult trading conditions in United States, UK, even their women's range. They mentioned it was fully restocked in mid-April, but has not maintained the level of daily sales initially experienced in the months immediately following its launch. So maybe there should be a women's underwear index as well. So potentially these are indications that the economy is under stress now, and that would fit the narrative we are hearing that there is a possible recession heading our way. And maybe this is one of those signs, and maybe the men's underwear index is doing its job. Now, what excuses have they given for the decrease or significant decrease in EBITDA? And the first focus or excuse is on United States. They mentioned that United States experiencing higher than expected customer acquisition costs and return a loss exceeding $3 million in financial year 22. Now, whenever I hear a company is trying to expand in the United States, I understand why they might want to do it. And it's also true for China. But a lot of companies try to expand in those countries and completely fail. It's not a given that even though they want to, they will succeed. So step one hasn't succeeded yet, and they are paying the price right now. They also mentioned marketing and advertising costs are higher than expected in both the USA and UK, and will be approximately 46% of revenue due to increased digital marketing competition and lower than expected return on ad spend. They also mentioned cost inflation and sustained COVID-19 lockdowns in China and the war in Ukraine. So all the types of excuses you would expect for a company that has just issued a significant downgrade. That's all I have for this video on the horrible IPO that was step one. We also had a glance-through look at the men's underwear index. Is there a link between the performance of step one and the state of the economy now? And can that be explained through the men's underwear index? If you have any questions about anything I've discussed in this video, leave your comments, your questions, your thoughts in the comment section of this video. Otherwise, that's it for now. Oh, the last thing I should mention is I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.